All right, everybody. Stocks by the numbers. Welcome back. Real quick vid here going into earnings tomorrow for Foot Locker, ticker symbol FL, listed here on the New York Stock Exchange. Now, this company right now in the technicals looks like it spiked up here off of this fib first week of August, and we have a potential ascending triangle forming here. So, if these earnings aren't that bad, then in my opinion, if we bounce this out all the way to this trend line, you're looking at, about 35, 35 and a half, it looks like. And this is a trend line that I drew out. As you see, this is going back from the high on May 18th, 21, it looks like, to March 20th, 2023. That's this top trend line coming down, cutting across here. So you can see in the immediate short term, again, if these numbers are good with the ascending triangle setting up, we could see about 35 and a half. If they happen to really surprise, we can go to this top resistance trend line here, as you see, looking like maybe about 41 and a quarter. But I don't know. In my opinion, I actually think numbers may come in light. However, the earnings have been pretty solid now. As we see, they actually suspended their dividends. We're getting no dividends here throughout 2024. The company was consistently paying dividends, but the EPS and the revenue has been pretty solid. But if we look last quarter, we can see we had a very, very slight miss. Company brought in 1.874 billion on estimates of about 1.88 billion. So they missed by about 10 million in change, or about 0.5%. The profitability side really hasn't seemed to be an issue. However, we can see that with this quarter coming up, we're actually expecting a loss of a little over 7 cents a share, with basically the same exact estimate of 1.888 billion. Now, of course, they could do it, right? But they could also miss. But I wanted to look at some of the numbers here because we have a market cap 3.1 billion. We're losing almost $4 a share. As you see, the EPS has been beating 3 of the 4 last quarters. However, now again, we have profitability really dropping down. You can see Q2 seems to be one of their weakest quarters, but I wanted to show you this as well. First of all, we have profitability and potentially revenue actually stagnating. We went from about 7.5 billion up to almost 9 billion the year after lockdowns. Then you can see we're kind of slowly trickling down, 8.7, 8.1 billion. Also, more importantly, you can see the net margin percentage went from about 10% now to minus 4%. And also, you can see that, yes, Q4 usually seems to be their best quarter. I would assume probably around the holiday season. But also, if we look at this time last year, you can see Q1 1.93 billion, next quarter 1.86. So technically, year over year, 193. Now the company brought in 1.88, which is what they're expecting next quarter. But as we saw from this time last year, we may have a pattern of lower revenue in Q2 when compared to Q1. So if Q1 is down year over year and it's at 188, but we're expecting 188, if trends continue, then we're technically, we have a strong possibility to report less than what we did in Q1, which obviously would potentially be below 1.88, which is what analysts are expecting for the quarter. So, in my opinion, I don't think the EPS is going to be an issue because they've been pretty solid on the EPS. So you might have a situation where you have mixed earnings again, just like you did last quarter here, where we have solid EPS and we may just have kind of inline or a slight miss on the revenue side. But in my opinion, I think they report like the low 1.8 billions or maybe even the 1.7s. I'm honestly expecting a miss, in my opinion, on the revenue side. But this loss here of about 7.3 cents a share, maybe the company could come out and post a loss of like 5 or 6 cents a share. Because I know, again, they cut the dividend. They're trying to get their ducks in a row, and they're keeping the EPS above these analysts' expectations. So in my opinion, I'd be more worried about the revenue than the EPS report, but I would personally probably play puts here. Again, we have a 3.1 billion market cap, and if we pull up just a couple of, as you see, no dividend, we have assets technically outweighing liabilities, both the short and the long term. The debt went up above 3 billion. Looks like it came back down 2.93, 2.94, 2.93. Free cash flow, as you see, technically moving in the right direction, was minus 177 million this time last year. Now we're at minus 18 million. Cash has gone down even though we've cut dividends. Excuse me, cash dipped below 300 million. However, we have almost our market cap in debt. If we look here, we can see equity was kind of holding that 3.25 billion mark and recently dropped down to 289 billion the last 2 quarters. We have assets down almost a billion over about the last 18 months, with liabilities down about 10%, still holding above 4 billion though. So we have equity of sub 3 billion, and look at the debt, 293 billion. So in my opinion, that kind of cancels each other out. So then we have to switch over here to the revenue, which, as you see, 817 billion. They lost 300 million, but we'll call it 8 billion. And then we have cash on hand of a couple of hundred million. So you could make the argument, I mean, even trending downward, even if you wanted to like cut that number in half, you can say maybe like the fair value of the business right now would be potentially about 4 billion, which of course would still be about a 30% move from where we are right now, which would bring us to about 40 plus, which is why, again, if the company happens to surprise, we could see that big spike up to that top trend line again, as you see, which would potentially be 40 plus. But again, in my opinion, I would personally lean more towards puts. And revenue hasn't been too bad, but again, technically, we are slightly down year over year on Q1, and then Q2 usually goes down as we see. So this is why I'm saying, in my opinion, I would probably lean more towards the put side. But it seems kind of mixed over the last couple of years and couple of quarters, actually. 3 misses, 4 beats on the annual side. And again, the EPS, as you see, has been pretty solid over the years. So that's why, again, I'm saying I really don't think the profitability is an issue. I think it's going to be more about the actual revenue coming in for the business. And also there was a note here, Foot Locker's second largest shareholder, Visa Equity, sold 35.5 million worth of Foot Locker stock, or more than 9% of its stake over the past 7 sessions. Investors didn't really mind. I mean, you know, they're still one of the largest shareholders, so I wouldn't read too much into it. However, at the same time, maybe they're kind of just connecting the dots like I just did. And, you know, maybe they're thinking that this is going to be a rough quarter. And, you know, they might want to start trimming the position now, which obviously it looks that way. But they also said that there was an analyst here. Hold on. Yes, Baird analyst said in a note to clients Monday that while he's, quote, more confident in full year estimates, given how much the stock has rallied since early July, he believes, quote, near-term expectations appear elevated. Right? So, again, you know, not trying to boast. I didn't look at this article before I started making the video. So, you know, basically, we're all kind of coming to the same conclusion here, potentially. And it's rough because Foot Locker is known to really swing. I mean, you could see like a 10-15% swing after earnings. And again, unfortunately, we know that it's a gamble. And you can see, again, probably this trend line, you're looking at about 35.5 conservatively, potentially 40 plus if it's a good beat. If it is a miss, I think it's going to give back basically all of these gains, and we're going to drop back down to the high or mid 20s. If we come all the way back down to this trend line, you're looking at about 24, which would be about a 25% drop from this current level, which might be extreme. So I'd say maybe like somewhere halfway, maybe about this 2806 fib level, in my opinion, is my personal price target right now, which of course would break the 20-day moving average. So I'm expecting a sub 30 drop. And if we look at stock charts very quickly, I'll let you go. You can see the RSI has been topped out for quite some time. They brought the stock up and essentially just flattened it out, which again, potentially forming our ascending triangle. And right now, you know, the RSI technically doesn't really matter because if the numbers are good, the stock should technically go higher. But we've seen situations where companies beat and the stock goes down. So even if they beat earnings, you know, if they guide that next quarter it's going to remain rough before they, you know, close out strong for Q4, if they close out the year strong with Q4, then again, we may see a pullback to like 30 and change here to this mid-Bollinger Band instead of popping up. So with the RSI here topping out, and you can also see that with this flattening, we have a potential MACD crossing to the downside. This is why I'm saying, if we have mixed earnings again with an EPS beat and a revenue miss, this is why I think this MACD crossing with the benchmark 70 RSI, we'll call it, I think that's going to add to the sell-off and fuel it even more, which is why maybe a pullback, in my opinion, to this 50-day 2742 looks about right, in my opinion. Let's switch over to the weekly. And we can see the RSI ran up the 200-day moving average just below 34.5. Stock hit a high of 33.94. So if we get mixed results, we may see an immediate pop up of a few percentage points after hours, and it may tick up and actually meet up with that 200-day and then start rejecting and start to pull back. But technically, over the last couple of weeks, really, for the month of August, the stock spiked up nicely, bouncing off of the 50-day moving average here on the weekly, and has been on the up and up on anticipation of these earnings. But again, in my opinion, I think it may be a little bit of a mixed report, and with the RSIs potentially kind of near the upper side of the range on the daily and the weekly, this is why I'm saying, in my opinion, I'm expecting a pullback on FL. But let's check the pivot points real quick. I'll let you go. But yeah, technically in the numbers, again, if we subtracted the debt from the equity like we did, we're basically left with our revenue. And as you see, the revenue would be about $8 billion, even if we're operating at a loss. Again, if you want to look at it as, maybe a $6 billion, $7 billion company, as you see, the market cap here is only 3.1. But unfortunately, this is something that almost reminds me of a Goodyear tire, right? In my opinion, like, the numbers don't look that bad. However, the problem is it swings so much from a quarter-to-quarter basis that everyone kind of just changes their price targets consistently and changes their outlook consistently on something like a Foot Locker, because all it takes is, one or two rough quarters, and then everyone starts beating up the stock, and it might be stagnant for a year or two. Reminds me very much of Goodyear tire. But I wanted to look at the enterprise value as well. Where was that? Yeah, as you see, the enterprise value, again, what another company would be willing to pay for it, supposedly. Right now, the current enterprise value, $5.75 billion, which, again, if we have the debt, wipe out the equity, we're still bringing in about $8 billion and change a year, which is why, valuing the business at $5-6 billion and change, in my opinion, does kind of make sense. So that's why, even if we get a mixed report and we do see the pop up to the mid-high 30s, in my opinion, I wouldn't be shocked either. So I know some people asked for a quick review here going into earnings, and I know I'm coming late, about 30 minutes before the close. But honestly, in my opinion, I didn't really jump on this one earlier today, because personally, this would not be one that I would play. Because we basically just kind of laid out where you can have a scenario where we can either see 40 plus or we can see like 24. So, of course we want to get it right and nail the call and see big returns, but, it's a big gamble, and we know that all earnings are always a gamble, but you try to, find the plays that are you have a little bit more conviction in, right? So obviously, if you feel better or worse compared with how I'm looking at it, of course, let us know down in the comments section. If you're jumping in calls, let everyone know why you feel so confident, why you jumped in calls, why you think it's undervalued, why you think they're going to report a good quarter. Or on the flip side, if you think that they're struggling and you're kind of connected the dots like I did, year over year, it looks like revenue's going down. Q2 revenue looks a little lighter than Q1 compared to last year, so you're kind of leaning towards puts. Again, let us know down in the comment section, but you can see the price to cash flow was up here in the 20s. Now we're down here at sub 12 times cash flow. We're trading above 1 times book, but we were above 1 slightly. And then before and after that, we really stayed below that 1 price to book ratio. And of course, you can see again, looking at the price, looking at the book value, you can see we were up to almost $36 a share and took a haircut down to 34, and now we've been technically declining for the last 6 quarters in a row, and now we're approaching $30. So technically the book value per share is down, like 17-18% just over the last 4 or 5 quarters. So that's why, again, in my opinion, I kind of agree with that analyst that we just read about, where I feel that long term really shouldn't be an issue. because people are familiar with the name Foot Locker. You know, they get a lot of foot traffic. Obviously, they still get business, right? 8 billion a year. But in the short term and the near term, I do kind of agree with that analyst, and I just think that the estimates are a little too high. And if I was forced to, I would personally buy puts on FL, in my opinion, not calls going into these earnings. But that's pretty much it. Our return percentages are down. Gross margin technically climbing up the last couple, actually just the last quarter, back up to above 26. But you can see before that it was almost 30. It was around 28. So this is why, again, in the near term, it may continue to struggle. Look at the operating margin. Hit a low of 0.8. Now it's at 1.7. So that's the second lowest it's been going back the last several quarters. And even before that, it was in the 2s and in the 5s. So EBITDA, again, we kind of looked at that before, and the net margin percentage as well. You can see how we went from 4% and even more than that, obviously, a couple of years ago. Now we pulled back to about flat, break even, had a big drop to negative, and now as of last quarter, barely reported net income positivity, even though they didn't, right? Oh, no, they did. My apologies. But again, in the longer term, if you look at the fundamentals like we just did, and you want to look at the quote-unquote fair value of the business, if you believe in it long term, honestly, I wouldn't really fight you on it. In the short term, I do think it still remains rocky. Inventory turnover bouncing around, technically down quarter over quarter, but you know, higher than it's been. It was back above the 4s though. Asset turnover technically up, but seems relatively flat. Our debt ratios are slightly up. Again, in my opinion, I know it's a brand name in the space, and I know it moves, so a lot of people may be interested in earnings, and anyone who jumps in, I wish you the very best of luck. But again, in my opinion, it just kind of seems unpredictable in the current state. So I would have more of a wait and see reaction. I would let them come out with the numbers and listen, if they're good, and, you know, let's just say it pops up to like 35, right? In my opinion, I would consider then jumping into calls with maybe like a month of time and just kind of ride this climb maybe up to 40 plus, right? And on the flip side, same thing. If they happen to come out mixed and the stock goes from 32.70 down to like 30, then in my opinion, probably the same thing. I would buy a couple of weeks worth of time, and I would kind of play the puts down to like 27, 26, and I would just kind of ride that sell-off after these numbers, get in, get out, and then obviously longer term, if I want to buy on a dip and play it for the long term, obviously we could take it from there. But that's pretty much it, and I know it's not necessarily, you know, a clear-cut decision based on this video, but like I always said, I'm always honest. I don't sugarcoat anything, and I'm never going to tell you what you want to hear just because, you know, you like me or the channel or you wanted to see a video. And we have to call it like we see it. And right now, I personally wouldn't play it, but I'm going to end it there. So once again, Stocks by the Numbers, thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually pretty quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, they're very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for your time. Have a good day.